It's Kevin Lapp here, and I'm with a good friend of mine that I've worked with for years, Jean-Guy Turcotte from Regional Mortgage. We're doing an Ask the Experts video segment, really to educate the consumers on some of the changes that have taken place over the last little while in the mortgage rules, what's happening in the real estate market, so that the consumers in our marketplace in Central Alberta are very well aware of what's going on and what some of the changes may impact. So one of the questions I know everybody's looking at, there's been some changes in the mortgage rules, interest rate hikes, a few other things. So maybe Jean-Guy, you can step in and just kind of explain to myself and to the consumers, what some of these changes may affect them in the home buying process or lending or refinance situations.
There's been changes ever since I've got in this industry, and I've been doing this since September 2006, just like you.
Yeah.
And one of the things about our industry is that there's always change.
Yeah.
There's been all of these major changes. We've been talking about mortgage rule changes since October 2008 is when the first one came out. And then there's actually been subsequent changes every 12 to 14, 15 months, every year after that. The big ones that are most affecting the last couple of years has been what they call the stress test. Now, the stress test is where the lenders and the government institute that you have to qualify for a higher interest rate, meaning a higher payment, even though you're only paying a reduced amount, to qualify for not just today's mortgage payment, but the next ones as well. Because they anticipate that rates are going to rise, so they're pricing that in today.
Sure. I mean, we're seeing it, but the consumer themselves are still qualifying at the rates of 3%, 3.25. What are the rates that they're actually going to be not qualified on, they're actually going to be paying.
Getting, absolutely. So the rates that are in the market today, I mean, we've got variable rates as low as prime, which is 3.45 minus 1%, so call it 2.5%. But then you've got fixed rates, and everybody's got a different tier now with all the changes that have come about. Whereas the fixed rates are as low as 3.19-ish and up as high as 3.69 to 3.79, depending on the product and the tier that particular client qualifies at. And everybody's got a little bit different financial fingerprint.
Sure. And
that financial fingerprint is going to determine exactly where you're going to land. And the big thing about today with all of these changes is that people just need to prepare more. And that's part of that education that you and I provide to everybody and our teams to make sure that everybody is better informed, better educated on the market today.
So what are some of the things that the consumer can do to better prepare when they come to meet someone like yourself or getting introduced or want to go out and look at properties? I know for us it's very important that people are educated up front, get connected with somebody in the marketplace that can give them the right information. But once they're there with you, what are some of the things that the consumer can be preparing for to help facilitate that process on your guys' end?
Everybody has their own financial fingerprint and everybody gets their own custom mortgage.
Sure.
So my job is to analyze exactly, and my team's job is to analyze exactly where they stand, make sure that they're fully prepped for if they're buying 5% down, 10% down, talk about the little nuances about that. Maybe if they've got some credit blemishes that we need to repair, go through all that, see where they're at with their positions. I mean, ideally, the basic rule of thumb for lenders is they want to make sure that you're stable. They want to make sure that you have cash. So when we have a look at everything that you're preparing or have, we want to see your income. And ideally, the lenders are looking for, as a minimum, 2 years worth of credit on 2 loans over $2,000. They want to see that you have 5% down payment as a minimum, or how are you getting your down payment? Is it some of it saved up from your own? Is some of it from mom and dad? Is it in your stock plan, your RSPs? There's so many different variables in there, but the structure kind of starts off the same. Explain what we do, explain what you guys do, us as professionals, and then we kind of manage through that to design exactly what you guys need.
So, Jean-Guy, one of the other things that I want to ask, is it true that with the big banks that they're rejecting more applications than normal?
They're making sure that everybody's prepared. So are they declining more? They're saying maybe no right now, give it a few months, maybe save up a little bit more, strengthen your application, be on your job a little bit longer than the 6 months you've been there. So they're just making sure that they're in a little bit stronger positions. Right now, it really doesn't feel like it's any different. It's just qualifying differently and a little bit more stringently. So it just goes back to preparing.
Yeah, it just seems like the banks are doing their diligence, want that comfort level that they're working with the right clients and
Absolutely, but the government is also putting the thumb down on the banks where they're auditing more of their files to make sure that the files are as presented and not having anything being forced or smudged by the banks or brokers or even the consumers. So they're just making sure that everybody's on the right side.
So just on that role, being credit unions, smaller banks, what's your take on that side of things, and what is that like for the consumers out there?
The banks, there's about 30 of them, give or take one or two, that are licensed in Canada by the federal government. Realistically, they're the ones that govern that, and they're the banks, and make sure that the rules are all abided by. So when you see that the national rules have changed, it's mostly just for those banks and those lending institutions that are federally governed.
Okay.
Now, the credit unions are provincially regulated. Now, for the most part, they follow and abide by the banking regulations because there's some back-end partners that if they're securitizing a pile of mortgages and they're selling them off, they all want them to be abiding by those banking guidelines. But if the credit unions are using their own funds and savings, they don't have to abide by those federal guidelines. So the relationships with some of the credit unions are a little bit more lax than the current national bank regulations have just come into play. So it does give them a little bit of leniency right now. We don't really know if the government's going to press their hand on them, but they haven't yet. There's a credit union that we use as one of our largest partners. They actually abide by the national guidelines right now, and they have since they come out. But there is on the one-off file for a strong enough consumer that they can actually relax those a little bit. So that's nice to have those relationships with some of these credit unions that we can get just more done sometimes.
Bloomberg put out a report last week. What is your take on that? I know for me, and especially here in central Alberta, a lot of the impacts with stress tests, increases in mortgage rates is a real correlation to the two big players, which is Vancouver and Toronto's markets. And unfortunately, we're recovering from economical turmoil in Alberta because of the commodity pricing, which is rebounding, which is great. But in the same standpoint, these changes on top of what we're already dealing with, what's your take in regards to that?
If there was a class of kids and that represented all of Canada, the whole class is being punished for Toronto and Vancouver having the rising prices that they have. We, even in our recession to Alberta for the last couple of years, and the prairies really haven't had that growth rate that they have, but we're feeling the pressure to keep inflation down. But we don't seem to have that issue here, but they paint it all with one cloth. My takeaway on that is Albertans are resilient, and we fought through this already, and there's a lot of us that are coming through on the other side that are very well prepared, and consumers are stronger now than they have been. So those that have been preparing for the last year and a half, they're coming to the market now, and they know that these interest rates are still discounted deeply.
Yes. They
know that the prices in Alberta are kept down. So the opportunities to buy in our area right now are massive. The upside, if we've made it through the recession for the last couple of years and call it flat pricing, flat values with low interest rates, I still look at Central Alberta as being on sale.
No, I agree. And as we transition from a heavy buyer's market and start to see some stability and absorption take place in the market, I think it's an opportunity. And investors, or whether you're a first-time buyer or someone who's looking for that next investment opportunity, we've got to start looking and obviously being educated in regards to that transition as we move forward.
Absolutely. And the biggest thing to all this is just planning for it. So if you're not buying until for the next few months, 6 months, next year even,
that's okay.
That's fine. That's what you need to do to plan and prepare in this new mortgage reality that we live in.
Yeah.
So I call it over-regulation, but it is what it is. But the planning and most prepared are the most successful purchasers out there.
Yeah, and we find the same thing. I think it's important for us to be able to connect with people who are thinking about being in the marketplace, whether that's today, tomorrow, 6 months, a year's time, is getting connected, have a relationship, build that information in that portfolio so that when you're ready to pull the trigger, you're in a good position.
100%. I agree.
Yeah, so always, Jean-Guy, it's a pleasure meeting with you, and I appreciate you taking time out of your day to help educate what's happening in the marketplace, and hopefully we'll be able to continue this and be able to contribute.
It's always my pleasure working with you guys.
Okay. Thanks, Jean-Guy.
Thanks, Kevin.